Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for a new kind of format on our Tuesdays and Thursdays videos, 3 p.m. Eastern, every Tuesday and Thursday, kind of answering your questions as well as some of the biggest news. Today, we've got a big one. Obviously, AMC, shares of AMC have dropped over two-thirds since that conversion last week, plummeting. They're up just 4.6% today, but not making up any space, all the way down from about $45 a share on a price adjusted basis over the last week. Looking very attractive right now. I'm going to tell you a few catalysts that we might see that could send those AMC shares much higher over the next few months. It did get an upgrade by Wedbush to a $19 target price. That would be almost double from the current price. We're going to talk about what they see in the stock and if you should be investing right now. We're going to change the format a little bit on what used to be live streams these Tuesdays and Thursdays. Live streams just kill a channel on YouTube, folks. I don't know why. I don't know why YouTube doesn't figure that out, but they really slow down the views. So what I'm going to do, I'm going to record these videos and then go to the comments to answer your questions from the comments. So still going to have that Q&A feel. If you want to have a question that you want answered in these Tuesdays and Thursdays videos, please go to the video that was posted maybe Monday or the Friday before, ask it in the comments, and I'll be sure to answer it on those Tuesdays and Thursdays videos. So let's get started because this is, again, a very important topic. I wanted to talk about this. First, though, very important news. I was able to get a special promo code for one of the research tools that I use, Seeking Alpha Premium. I use it to get different perspectives, and the screeners are very detailed. The best feature by far is this dividend estimates tab that shows you how much a stock is going to pay over the next 2 years. Use the link I'll leave in the description. Try it for free for 7 days. And if you like it, through that link, you're going to get a $50 off premium access. So make sure you check that out. I want to get back to our topic though, because again, Wedbush just upgraded the stock. Shares of AMC Entertainment Holdings, ticker AMC, up to $19 price target. They still have a neutral rating on the stock, but I'm taking a second look at this and some very attractive valuations here. We do see that it is up about 4.7%. Not really the major jumps that we're used to with AMC, but it did fall 20 or more than two-thirds since its conversion just last week. So if you don't remember, the company carried out a 1-for-10 conversion and 1-for-10 stock split. Okay, that means if you had 100 shares, you have just 10 shares now, right? A 1-for-10 conversion is a reverse stock split. It's a lot of times meant to boost up the price of a share to keep it from being delisted by an exchange. Most of the exchanges require that you have a dollar share price to remain listed. That wasn't really the case here for shares of AMC. They did it as part of that conversion. They converted those APE shares, ticker APE, into common shares. And that was a stipulation of the conversion that they did that stock split first to not dilute current shareholders quite as much. Now they have the ability to sell an additional 390 million common shares. That is very important here, folks. The reason why they had those APE shares, the reason why they issued those preferred shares, that ticker APE, was because in the company filings, they were not able to issue any more common shares. They desperately needed funding over the last couple of years since the pandemic, obviously, as well as very intense streaming competition from those streaming services. Theaters have been going bankrupt. We've also already gotten bankrupt from several companies. AMC had needed that financing. Debt financing was way too expensive on its credit rating, but it couldn't issue any new common shares. So what it did, it issued those APE shares, those preferred shares, with the intent to convert them to common shares and then allow it to issue more common shares. That brings in that necessary financing to keep it from going bankrupt. Again, it's now able to issue 390 million new common shares. That's worth about $4.5 billion at the current price. I believe they're probably going to wait for a little bit, see if they can get a pop in the shares up to $15, maybe $20 each before issuing any of those new common shares, really with the intent of paying down some of this debt. We're going to get to why that's so important, the debt and all the fundamentals in this stock. But first, one of the biggest questions here has Reddit and a lot of those apes, those meme investors, left this stock? Obviously, they have not been able to prop up these shares as they have in the past. We're down two-thirds over just the last week. So I wanted to check kind of the mentions on some of these tools, some of these online tools that track mentions of a stock in these Reddit groups, especially this Wall Street Bets. Here we're looking at the top 20 tickers. I've got this down to just AMC. We can see the mentions of AMC on Wall Street Bets over the last 100 days. And you can see it was just a ghost town here for most of that period. Then over the last couple of weeks, since mid-June, mid-July, really, when it looked like they were going to be able to do that split, they were going to be able to convert the shares. The mentions just took off. Now, what's important here is this doesn't say sentiment. This doesn't say whether those mentions were bullish, bearish, what people were saying. This is just pure number of mentions on AMC. We do see that it has increased. It has remained at a pretty high level. And what's interesting, if we compare that to a couple of the other stocks that are frequently mentioned, they're on Wall Street bets. I've got here in yellow is Nvidia. There in kind of pinkish is Tesla. You can see that those mentions were fairly consistent over the last 100 days. It's only AMC that really fell out of favor for much of that time when the stock really wasn't doing anything, wasn't making anybody rich anymore. It's since popped up, so we do see a much higher interest, much higher mentions of AMC on Wall Street bets. And in fact, if we look at the data a little bit differently, we do see over the last 24 hours through yesterday, 1,000% increase in AMC mentions. So there is definitely more interest, more talking, and more upvotes about AMC in Wall Street bets and Reddit subreddits. That said, when we're talking about the Reddit mentions, those meme stock investors, things like that, we have to also ask if have too many gotten burned to save it. We do see increased interest, increased mentions there on Wall Street bets on Reddit from a lot of the meme stock investors. If a lot of them have been burned in the past, though, they might be a little hesitant to jump back in at these prices. I'm going to show you why there are still some catalysts, though, for the shares to go higher. And I believe a lot of those Reddit investors are going to come back. Another big question here for AMC is that short interest. Can we get a short squeeze that really drives those stocks higher? That price higher. So here we are in statistics on Yahoo Finance. We can scroll down here. We do see that the short interest, the short percentage of float is still at 32%. Now, of course, this is as of August 15th. The stock has come down quite a bit. I don't believe that has changed a great deal. Obviously, if there's a much less short interest as a percentage float right now, if a lot of those shorts had then bought back their shares to return it from that loan position, then we wouldn't see the kind of downward pressure on the share price. So I believe this is still pretty close to where it is right now, this 32% short percentage of float, which would mean we have a very strong potential for that short squeeze to, again, push that stock price higher. Onto the outlook for the stock. Again, we did see Wedbush upgrade the stock just the other day. It expects the domestic box office sales. So box office sales for domestic movies here in the United States up 28% this year. That kind of surprised me. I guess last year was still a very much into that pandemic low. They're expecting 28% increase and AMC to take 22% of that. I think that's very important. We're obviously still seeing a lot of competition from streaming. We're obviously still seeing lower box office receipts compared to pre-pandemic. But if AMC can take that commanding lead, that 22% share, then I think it's going to be able to take advantage of as a lot of these other smaller cinemas bankrupt or really run out of cash. AMC is going to be able to take advantage of that and take more of that share. So even if it's a smaller pie, even if it's a smaller domestic box office and cinema market, AMC is still going to be able to take a commanding lead of that and higher revenues. Wedbush did increase their price target to $19, which again, that is almost double the current price, right around $11 per share. They increased that price on improving fundamentals that we'll talk about right now. It is interesting that they're still neutral on the recommendation. It was from a sell recommendation previously. So it's odd that some of these Wall Street analysts can say that they have a price target, a fair value for a stock that is almost double the current price. They're still not going to take a chance on the shares. They're still neutral on the shares. On to the fundamentals. And one of the most important things you want to look at these very risky, volatile stocks is the debt. Okay, companies go bankrupt because of debt. Okay, if they cannot bring in the earnings or the cash flow to cover those interest payments, they file bankruptcy, they wipe out investors, and they'll just restructure and issue new shares. We might not see that as a problem here with AMC. One thing that really surprised me looking at this stock a little closer is they have paid down a lot of debt. They used that APE conversion, that preferred share conversion, and the money that brought in to pay down a lot of their debt. It wasn't necessarily good for those short-term traders and short-term investors because it diluted their share of the company, but it did pay down a lot of debt and clear up a lot of the existential problems for this company. Okay, so if a company pays down its debt, even if its operating performance does not improve, even if the cash flow is still negative, it can still survive for a very long time. Because it just doesn't have that debt overhang. We do see here in the financials that we can go to the balance sheet to look at how much debt this company has. We go to total liabilities. We have the current liabilities of about 1.6 billion. Non-current liabilities is what you want to look at here, and you want to look at this on a quarterly basis so you get the updated there. But if we go total non-current, it is sitting on right about $9 billion in debt right now. Again, it has the ability at the current price to issue those 390 million shares to clear up about a $4.5 billion in that debt. I believe they're going to wait until the share price comes up a little bit, giving them the opportunity to clear away a lot of this debt. Here we can look at the operational outlook. According to analysts, we do see that revenue down here at the bottom. Current year 2023 revenue is expected to be right around $4.6 billion. That would be 18% higher than last year. So they are experiencing a very good year, a good rebound year, especially off that Barbie and Oppenheimer release. It might get the Hollywood strike is still ongoing, and a lot of studios are delaying those releases or the production. So that could weigh on this operational performance next year, could weigh on the stock if that's not resolved. I'm going to talk about that in the potential catalyst we'll talk about next. But right now, it's looking at like they're going to have a very good year. 18% sales growth this year, 3.7% sales growth next year to 4.8 billion. I do believe that could be higher if we see any kind of a stronger production schedule, a clear up of this Hollywood strike, and any kind of blockbusters next year. Now, on the earnings estimates, they do see a loss of $2.60 a share. That would be a vast improvement, though, over a loss of $8.20 last year. Analysts see the company narrowing that loss to $1.80 per share next year. So again, what's important here is if it can pay down that debt, and now it has substantial ability to do that, it is no longer an existential question. Okay, companies go bankrupt because of the debt. If it clears up that debt, it doesn't have to answer that question anymore. Even if operations performance even slowly, very slowly improves, it can still wait that out. It may even get private equity or activist interest eventually. Okay, private equity firms love to come into these stocks with a very strong brand name, very strong commanding lead of the market. Again, AMC controls 22% of the domestic box office market. I believe it's going to pick up more market share as the other smaller cinema operators fall out of place. So come in there, buy up a company with relatively little debt. And again, AMC will have relatively little debt once it pays off the debt from an increased share sale. So a private equity investor, private equity company can come in, buy up that company with very little debt, re-leverage it with more debt. That's just the modus operandi for private equity companies, and then even and turn it around and then eventually sell it off for a huge profit. I believe that's what very well could happen eventually, but not over the next probably not over the next year. And that's where our catalysts are for improvement in the stock price. And I do actually see four potential catalysts that could send this stock higher, up to that $19 fair value that Wedbush has, even up higher. So a potentially doubling of the stock price or even more. One is obviously the end of the strikes in Hollywood. We've got the Actors Guild as well as the writers' strikes. They are stretching out here. The longest writers' strike was actually in 1988 at 153 days. That was more than a week longer than the 1960 strike and about 4 weeks longer than the current one. So we are coming up on that breaking point. We have seen several studios push back a lot of films as far as production and release. So that is going to start weighing on box office sales into next year. I believe once this strike ends, though, it's going to be a big sentiment catalyst. Okay, people are going to see an end to it. They're going to see better times ahead for the box office, and that's going to flow through to a lot of these related stocks, especially AMC. Another catalyst potentially from that is going to be any multi-day positive movement in the stock price. That could reignite Reddit buyers. It could start squeezing the shorts out. Okay, what we want to see here is on top of today, that 4.75% increase on top of today, we want to see multiple days where it keeps going up. What I'm talking about here is the short sellers there's going to be a point where the short sellers see really marginal return to this trade. They're paying a lot of money to borrow those shorts, to borrow that stock, and then sell it into the open market. There is a yield, a premium that they have to pay to be able to do that. If they don't see the stock falling quite a bit beyond where it is right now, and I don't believe it's going to fall that much more from where it is now because it is coming very close to the fundamental value of these shares, then marginal or the short investors are just going to start selling out. That could eventually lead to a short squeeze. That's another catalyst I'm going to talk about just a minute here. But that multi-day positive movement, that is going to bring a lot of the retail investors, a lot of the meme investors, a lot of the investors that drove it up, two, three, four fold here last year. They're going to start seeing big money being made in this stock once again, and you're going to get that bandwagon effect. So I think that's another catalyst. Again, it could start with an end to those strikes, being the positive catalyst that drives the stock up initially, or it could just start with a multi-day positive movement in the stock, bringing more and more investors in, not wanting to miss out on that boat. Another positive catalyst here could be just the company coming in to issue some of those shares, that 390 million shares that it can now issue to pay off that debt. Obviously, it's going to be dilutive of current shareholders. It could bring the stock price down a little bit initially, but I think a lot of people, especially institutional investors, the short sellers, are going to look at that. They're going to say, well, this company is clearing up that major fundamental problem, that existential question of the company of whether it will go bankrupt because of that debt. And if it's paying off that debt, you no longer have that question. A lot of those institutional investors, a lot of the short sellers are going to see that and not going to want to be in the way of this stock. So even after that slight dip, when they do announce that debt pay down, that is share issue, even if it does dip a little bit, I think you're going to see very much stronger price action after that. And again, that fourth catalyst is going to be just the point where margin or short sellers see that marginal return disappear. Okay, to be a short seller in a stock, especially one as volatile and as one as expensive to borrow as AMC, you have to think it's going to go down to like zero or go down quite a bit to make any money on that. This company is only a $651 million company right now. There is high interest on that shorting. That's about 32% of that float. It's getting closer to that rock bottom valuation that just doesn't leave any gap for short sellers. Even if they make an additional 5, 10, even 15%, that isn't going to be much of a return compared to the price they have to pay to borrow these shares, or the risk that they run that these shares go up another 50, 100% from here. So I think a lot of the shorts, they're going to start reevaluating the risk and reward of that trade, and they're going to start getting out slowly at first, and then maybe even into a short squeeze later that really drives this stock higher. All told, right here, I think the risk is worth it. The risk reward in shares of AMC are very attractive right now. You risk maybe 10, 20% at the most downside from here, as opposed to a 50, 100% return to the upside, just back to that $20 fair value target and beyond if we get the Reddit investors coming back, if we get a short squeeze in the stock. Remember that no more than 5 or 10% of your total portfolio in any one stock, just in case it moves against you, but even 10% of your portfolio in this one stock, if that doubles, that is going to be a very attractive return for your overall target. And what's usually my favorite part of the live stream videos, getting to your questions. Again, we're going to do this through the comments so we can do a recorded video, not slow down the views on the channel. Looking through some of these here, I want to talk about, okay, so awesome video, awesome bow tie. I appreciate that. Talking about the QYLD video we see there. I see it has a beta of one to do the strategy you spoke about selling after a year. I would like to look for a fund that has a similar return, but a beta of negative. Any ideas? Now, this is very interesting. Talking about the QYLD, a very popular covered call strategy, where they are selling call options against the stocks in the Nasdaq 100. Not sure. I know what you're talking about. A beta of -1. There wouldn't be I don't think there are any funds. There are probably no stocks. Beta of -1. Um, you can do this strategy on your own with your own stocks, basically just using that covered call strategy that we talk about so often on the channel. Great strategy to protect your money. You're just going into the market, selling a call option against 100 shares of a stock or an ETF you own. You collect that premium, and then you don't have to, you lower your risk just a little bit. Comment by JAT says the big three auto companies staring at a looming UAW strike. So it's probably a good idea to hold off until these new contract is finalized. Okay, so he's talking about here. I've gotten very bullish on some of the legacy automakers, in fact, as well as Rivian. So Rivian, one of my larger EV stock bets. I also own very few shares of Tesla, but I do own some of that. But I also like Toyota. I like Ford, especially on their valuations, as well as just that potential in electric vehicles. Ford has had that F-150 truck as the best-selling car, best-selling truck for decades now. If it can work out the kinks in that F-150 Lightning, the EV version of that, it is going to see some massive growth. What they're talking about here is that UAW, the main manufacturer car makers union, is probably going to strike here. There could be some negative price action on a lot of these cars, but I think it'll be fairly short lived. They'll want to get back to work. I think probably you leg into your position. Maybe you invest half of the money that you wanted to invest now. Wait another 2 or 3 months. We could see some lower prices if that strike is announced. That's when you go in there and you really pick up at the lows here. Parker Moyes wants to know updated take on FCX, so Freeport McMoran, Teladoc, TDOC, Mosaic, MOS, and Tapestry, TPR. Okay, a couple of these. Tapestry, I know, has entered into a deal to acquire another company there. A little worrying. Obviously, these big acquisitions never turn out as well as they planned. It's going to probably put on a lot of debt for that. I haven't really looked at the acquisition, how it's going to finance that, but I would be out of Tapestry right now, as well as just a general weakness on the consumer. We've heard a lot of bad news, a lot of negative outlooks from these retailers. Maybe it hasn't hit quite as hard the luxury retail side of the market, but I would still be hesitant on many retail names right now, especially those that apparel and jewelry retail sector. Mosaic, so fertilizers. I still see a long-term growth trend in fertilizers, agriculture stocks. Mosaic is one of the best run there, so I would still be bullish on Mosaic. It's not a stock that's going to make you rich, but it is a good long-term hold for long-term price appreciation. Teladoc Health, obviously one of our big growth stocks that has been frustrating over the last couple of years. It has not is kind of lost that growth stock sales growth. It's now expected to grow about 9%, about 9-10% a year in sales. That is still very strong, and the valuation on this has dropped to levels that I'm picking up shares regularly, just dollar cost averaging into that. Teladoc is one of my favorite stocks for those growth industries that and a commanding lead of that growth industry. Okay, a lot of you have heard me talk about on the channel. This is my growth investing strategy, is finding those industries that are changing the world in which we live. Virtual healthcare, I believe, is one of those, going to be one of those. Obviously, it's not like it was in the pandemic where we have to see our doctors and physicians virtually, but it is just a common sense thing that it is going to continue to develop. It is much lower cost basis to use virtual healthcare, and I believe that's the way we're going to be forced into, just to keep medical bills and insurance premiums lower in the future. So we are moving into a virtual healthcare market. Teladoc, by far the market share leader, the dominant player in that. So I want to be in a growth industry and then in a company with the competitive advantage and the market share leadership in that. Teladoc is that company. While it might be frustrating over the last year not to see that take off like some of our other growth stocks, like SoFi, like a lot of the other growth stocks, DraftKings that we've been in, I do believe we will get there. So we just have to have patience in Teladoc for now. FCX, Freeport McMoran, major copper miner. I believe copper is one of those unmentioned commodities that people just aren't watching enough. Okay, electric vehicles use 3 times more copper because it's a great conduit of electricity. 3 times more copper than a traditional or internal combustion engine. Okay, so as we see those EV sales, that EV demand increase, it is just a no-brainer. We're going to see huge demand for copper, for the commodity. We also see copper used in all these sustainable construction. Anything that has an electric current running through it, which is more and more things nowadays, is going to need copper. We are going to run into a copper deficit. So the copper miners, because the price has been low over the past few years, copper miners and production just has not kept up. We are going to see a deficit in copper production over the next few years that is going to drive the price up, that is going to help miners like FCX to push their shares higher. Again, like Mosaic and like that long-term demand picture for fertilizer, for agriculture, FCX, it's not a stock that's going to make you rich, I don't think, but it will be a very stable long-term price appreciation stock that you can count on. Comment here from Christopher. Seeing Rivian's much more on the road now, and that is interesting because I just realized that just the other day after doing this video that we did this 5 stocks that could rocket next, and we talked about 5 stocks that could jump after this pullback. 5 stocks that were doing very well beginning of the year have fallen down in this pullback and are presenting very attractive valuations, and I believe are the stocks that you need to be in for when the pullback is over. We talked about Rivian, we talked about SoFi, Palantir, Snow, a lot of the AI software stocks, DraftKings, all very much growth stocks in that growth theme, and stocks that could come back quite a bit. And I have also seen a lot more Rivians on the road today. That's one thing that I've been investing in Rivian over pretty much the last 7, 8 months, is because I do believe Rivian is at a point where its production is going to reach that inflection point. If you remember, shares of Tesla just a few years ago, when it reached that production inflection point where they are producing just enough cars to start bringing that down, that cost per car, the profit, the loss on the income statement just plummets. It starts looking like a much better company, and that's when the stock really takes off. So I'm really excited about Rivian to see it reach that level right around 50,000, between 50,000 to 100,000 cars annually. I believe those costs are going to start coming down, and the stock price is going to respond to that. Again, make sure you get your questions and comments in the comments section in these videos. I'll address those in our Tuesdays and Thursdays videos. Use that link below to get that promo code for $50 off and the 7-day free trial to Seeking Alpha Premium. Try that out for free. Get a discount on a research tool I use every week. Or click on this video to the right for a great growth stock investing strategy and how it works on Tesla, investing $100 a month.